Welcome back, everybody. Stephen Morris here, Advisory. Today we're going to talk about your favorite subject, which is bonus depreciation. We love bonus depreciation because it substantially lowers or potentially eliminates all of our taxable income. And in tax year 2025, we got the reintroduction of the 100% bonus depreciation rate as prescribed by the One Big Beautiful Bill Act. Prior to January 20th of 2025, if you had any property that you placed in the service during those years, you were subject to potential phase-down limitations after tax year 2022. And so if you were unfortunate enough to buy a property on, let's say, January 1st through January 19th, unfortunately, bonus depreciation for you on those specific properties is limited to 40%. However, January 20th and forward, now you'll be able to realize or unlock the benefits of 100% bonus depreciation. Let's dive into the mechanics of how this works and what are some tips and tricks on how to understand it better. So we love bonus depreciation because, especially in the real estate world, we're able to generate these deductions by borrowing money from the bank in order to achieve this outcome. Normally, in the tax world, 99.9% of the cases, in order for you to achieve a deduction, you first have to spend the money. And this is the very reason why we typically don't, at Advisory, prescribe you going out to spend something solely to gain a deduction. However, in the real estate world, we kind of get to have our cake and eat it too. And in that instance, borrowing money, getting this huge deduction, and then using the tax benefits of that deduction in order to buy out more real estate fuels this engine and allows us to keep our taxable income low. So let's talk about the specific mechanics of how this works. You buy a property in, well, you know, we're in LA here, so let's choose Los Angeles as an example. And the property is $1.5 million. $500,000 of it is allocated to the land. As we know, land is not depreciable. $1 million of it is going to be allocated to the building. In the absence of doing anything else, we would have a $1 million building asset unit of property, which would be depreciable over a 27.5-year or 39-year life, depending on the use, whether it's residential use or commercial use. However, if we employ a cost segregation study, then we get the benefits of bonus depreciation. That doesn't mean we get to immediately depreciate $1 million. Instead, what's going to end up happening is a portion of that building, typically around 25 to 30% of it is generally the back of the napkin math, will be reallocated from the building to shorter lived assets, personal property at 5 years, land improvements at 15 years. Those type of assets are immediately eligible for bonus depreciation, and to the extent that you're able to allocate it from the building would be at a rate of 100%, assuming you got it after January 20th, 2025. Therefore, if we use this 30% number, we would generally generate about a $300,000 tax deduction from a result of the bonus depreciation, which is immediately deductible against our income taxes. Therefore, with this $300,000 deduction, we're looking at a up to $111,000 tax savings, dollar for dollar tax savings, assuming a 37% top rate. So does that mean you should start going out and buying real estate tomorrow to generate substantial tax savings? The answer is maybe. And the reason why it is maybe is because we have these passive loss rules that we have to consider too under Code Section 469. And in this particular instance, real estate has a little special place in hell in the code where it's considered to be passive regardless if you're actually working on it. So let's say you had a W-2 job, you're working in tech, you're working in sales, and on the side you have this apartment building that you've been working on. You saw my video and you stopped just about a minute before I told you about this part here, and you decided to go for this cost segregation study, you got this massive deduction, and when your tax preparer is working on the return, assuming he or she does it correctly, you're gonna see that this loss goes into the passive bucket. Why? Because you have this full-time job and it has nothing to do with real estate, and there's a lot of rules that you gotta get around it, specifically around the real estate professional status. And so for you to unlock real estate losses, you'd have to be considered a real estate professional under the code. And in that instance, you'd have to have over 750 hours in real estate trades or businesses. So you gotta be doing real estate stuff, property management, construction, asset management, all that sort of stuff. Also, all those hours of real estate stuff have to be more than 50% of all the stuff you do for money. So if you're spending 2,000 hours a year in your full-time job in sales and 500 hours, or let's say 750 hours, I should say, in real estate, you're gonna fail the test because although you met test number 1 on the 750 hours, you're going to fail the 50% rule because these 750 hours you spent, for example, in real estate are going to be less than 50% of the overall work that you're doing. I should mention one more thing. A lot of our viewers here have California real estate and they're very excited to live here on this part of the country. And they're assuming that if taxable income drops for the federal as a result of bonus depreciation, then certainly the same must follow for the state of California's taxable income. And unfortunately, we have a huge problem. California does not respect bonus depreciation at all. In fact, they specifically exclude it. And so when they're doing a reconciliation of California taxable income to federal taxable income, they're going to add back the effect of all the bonus depreciation that you took on your federal income tax return. Now, does that mean that a cost segregation study is completely worthless for California purposes? No, because remember, we're moving these assets from a 27.5-year life to a 5, 7, 10, 15-year sort of bucket. And at the very minimum, California is going to respect the reallocation of those assets. And so you're going to accelerate your depreciation in California. You're just not going to get that big one-time shot like you did on the federal income tax return. So it's still useful. It's just that a lot of times, especially our major sophisticated real estate investor clients, have an outcome where federal taxable income is like minus $1 million in terms of loss, and then you'll see on their California tax return $2 million of taxable income. They end up paying a lot to the state of California, even though they did a bonus depreciation cost segregation study. One last thing to wrap up this whole discussion. Remember that all these types of deductions and methods are more on the tax deferral side than they are on the straight up tax savings. Now, what ends up happening is if one day when you sell the property, the effect of you having bonus depreciation on the property and having substantially taken so many losses, it decreases the adjusted basis of your asset. And when it comes time to sell it, you're going to have to pay all that back at a 25% Section 1250 recapture rate. However, it's still coming back unless you do a 1031 exchange. So we love this type of strategy. 1031 allows us to keep kicking the bucket down the road. And that's the very reason why we love real estate investing so much. It is just such a tax-advantaged investment. So this helps you out, or you find that you want to know a little bit more about how bonus depreciation works, especially as it relates to the One Big Beautiful Bill Act, then feel free to contact us right here, and we'll be more than happy to assist you on your next acquisition. Thanks so much for watching, and look forward to seeing you in our next video. So make sure to like and subscribe to our channel for all the content related to real estate investment and tax saving strategies.